Hello and welcome to the Wright Know Your Money podcast. I'm Ashley Smith.
And I'm Tom Richards.
On the Know Your Money podcast, we talk everything finance from financial planning tips to how what's going on in the world around you affects the money in your wallet and most importantly, your financial future.
If this podcast helps you, please like and subscribe so that we can help as many people as possible moving forwards. In today's episode, we're going to be talking about active and passive funds. When investing your money, choosing an investment strategy can be as important as the level of risk that you take. There are thousands of different investment funds available to you as an investor, which can usually be classified into one or three investment strategies: passive, active or hybrid, which is a combination of active and passive, but which approach is best. This is a debate that the investment world has raged on for many years and will likely to continue for many more to come. Ashley and I are going to look at what passive and active investing is, the advantages and disadvantages of each method, and help you understand which approach could be best for you and your money. So, Ash, over to you. Could you start by giving our listeners an overview of passive investments?
Yes, thank you very much, Tom. So, passive investing is also known as index investing or index tracking, and it involves investing in a portfolio of stocks that mirrors a market index, such as the UK's FTSE 100 or the American S&P 500. By taking this approach, you're not trying to beat the market. Instead, you're simply trying to mirror the market. When using this approach, you usually expect to see a buy and hold strategy, as again, you're not trying to take advantage of what an active investor might see as a pricing anomaly within that market. The users of this sort of strategy usually believe that by the time information is available to an investor, it's already in the price anyway, and therefore you can't beat it. Now, when using tracker funds, there's usually two types. The first is a physical and the second is a synthetic. So firstly then the physical. The physical fund will simply purchase the shares of the companies within its index. So if you're tracking the FTSE 100, for example, that tracker may hold all 100 stocks within the index in the relevant weighting. Now, if there is an index that has a particularly large number of shares, that fund may use a technique called optimization, which is where rather than buy all of the shares in the index, it tries to create a portfolio that has a similar distribution in terms of regional weighting sectors. But the idea is that it will still track the market, but without having to hold all of those funds. Obviously, doing that, you may find there's a bit of a tracking error because it's not a direct mirror of the portfolio that it's tracking. The synthetic version of a passive fund then aims to track the market without actually owning any of the shares of that market. It does that by using derivative arrangements. Now, you won't go into what derivatives are and how they work. That will be a separate podcast. It's quite an in-depth subject, but it tends to be the preferred approach when you're looking for exposure to sort of less liquid or harder to access markets, such as commodities, where you don't physically want to own or take delivery of that commodity. The main positive with passive investments is that they're usually very cheap, so it's a very low cost way of getting a broad market exposure. As you're not paying for fund managers and analysts to make specific stock selections, these fund providers are able to keep their costs very low, which means that there's nothing over and above being taken out which can detract from your performance. One of the main downsides to passive investing is that you're usually quite limited in the selection within your investments. A couple of reasons for that. First simply could be that when you're tracking the market, you're sort of overexposed to a small number of stocks or sectors that could then have a large impact on performance. You can diversify away from that by holding numerous passive funds which track all different markets, but there will be some areas that just don't have any trackers available to them. Another advantage, or could be a disadvantage depending upon how you look at a passive investor, but you're unlikely to ever outperform or underperform a stock market. As we said earlier on, the idea behind these funds is to simply track that market. So if you're tracking it, you wouldn't expect to outperform, but likewise you wouldn't expect to underperform either.
Thank you for explaining passive investing to the listeners. Can you now explain active investing?
Of course. So where a passive fund aims to track a market, active investing involves trying to beat the market. And they do this by picking individual stocks or using actively managed funds where fund managers and analysts are trying to outperform that market. So unlike a passive investor that believes all information is already taken into account, an active manager or an active investor believes that investors are irrational. They have emotions, and those emotions and irrational acts can create inefficiencies in the pricing of stocks, which can be exploited. As you can imagine, active investing is much more time consuming because you are doing research and it requires greater expertise to undertake that research. With that, unfortunately, then comes additional charges because you are then paying for active managers, you're paying for analysts to do that research and try and find those companies that they feel are undervalued and hopefully avoid those ones they feel are overvalued. The main benefit, therefore, of active investing is the potential for higher returns or limited downside risk relative to a passive investor, because those fund managers are actively, as we say, trying to beat the market either on the upside or protect you on the downside. They can also be much more specific in their stock selection as well, because they can diversify away from that benchmark, from that index that they might be using as a sort of underlying tracker. Unsurprisingly, that's also one of the biggest downsides. With every active decision that's made, that decision could be correct, but it also could be incorrect. And if a fund manager gets these decisions right, great, you might see additional growth. But if a manager gets those decisions wrong, you may not necessarily see a loss, but you may see less growth than if you were simply tracking a market. Another positive when it comes to investing, I have touched on it, is that an active manager or an active fund, I should say, can often invest into smaller or under-researched areas, those which aren't necessarily available through passive funds. Fund managers will also have the ability as well to sort of take into account personal preferences. So some of our clients may have ethical preferences when it comes to their investments, and actively managed funds tend to be able to take those preferences into account, whereas a passive, if you're just tracking an index, you can't be as specific with that. So both active and passive have got their own benefits and obviously their drawbacks as well. And with most things when it comes to financial planning, an individual's goals, risk tolerances, and sort of views at that time will be relevant to them and may not be relevant to somebody else.
That's brilliant. Thank you for explaining the difference in passive and active investing. I know many of our listeners will be interested to know which of the two approaches are best for them. Could we now just touch on hybrid investing?
Yeah, so hybrid investing, and you may be expecting this answer here, but it's a combination of both active and passive. Many people believe that there is no right or wrong answer, whilst at the same time many believe one is better than the other. If you're of the belief that actually neither of them are right on their own, you can blend the two together and come up with a hybrid portfolio. In doing this, you can effectively try and get the best of both worlds, and it is becoming more popular, not just with ourselves or our clients, but in the wider investment world. It's certainly useful for those that want to have sort of a low cost, broad market exposure by using passive or tracker funds, but also want to be a little bit more active in other areas as well, certainly if it's to do with ethical preferences or somewhere that's been historically more volatile or an under-researched sector. Using an active fund blended with your passives can give you the sort of best of both worlds there. At Wright, we offer different investment strategies for our clients, and when investing your money with us, we'll discuss the pros and the cons of each type and help you to choose the approach that's right for you, or even the combination of approaches that are right for you. If you'd like to review your investment strategy and see if the one that you're currently using is in keeping with your preferences, please contact myself or any of the chartered financial planners here at Wright. The best way to do this is via our website at www.howardwright.co.uk and complete the inquiry form, or contact us on 0345 688 4939. Thank you for listening to the Howard Wright Know Your Money podcast. I've been Ashley Smith.
And I've been Tom Richards.
If you're watching this on YouTube, please like and subscribe or share on your socials. And if you're listening to us on Apple Music or Spotify, please drop us a follow and leave us a review.
It really helps other people find the podcast, enabling them to know their money better and build stronger financial futures. Please check the Howard Wright link tree below for loads more tips, tricks, articles and podcasts just like this one.
And most importantly, stay tuned for future episodes. This recording contains information from sources believed to be reliable, but no guarantee, warranty or representation express or implied is given to its accuracy. Howard Wright does not undertake any obligation to update or revise any future statements. Past performance is not a reliable indicator of future results. Investments can go down as well as up, and actual results could differ materially from those anticipated. This recording is for the information purposes only and has no regard to the specific investment objectives or financial situation of any individual. The information contained in this recording is not intended to constitute and should not be construed as investment or financial advice. Appropriate personalised advice should always be taken before entering into any transactions. No responsibility can be accepted for any loss arising from action taken or refrain from being taken based on this publication. Howard Wright is authorised and regulated by the Financial Conduct Authority.